And right there on that day would have been the best day to get back into the market after it crashed in March of 2020. Welcome back to Stock Tricks with Nick. I'm Nick, and today I'll be explaining how to identify the best time to get back into the stock market after a correction. Right now, the stock market is weak and in a short-term downtrend. The S&P 500 and NASDAQ, the two major indexes, are both under their 50-day moving average. And we've had large volume sell-offs indicating that institutions are liquidating positions in fear of a larger move down. Since March of 2020, we've been rewarded for buying the dip. But if this recent dip turns into more of a correction or even the next bear market, then when's the best time to get back in? Follow-through day. A follow-through day is a signal that a rally attempt off the lows of a correction is valid, and we can mark it as the start of a new uptrend, making that the best time to start building exposure in the market. In this video, I'll be covering the requirements for a follow-through day, what to buy when that happens, some warning signs that a follow-through day is more prone to failure, and finally go through some historic examples. If you enjoyed the video, do me a huge favor and smash the like button and subscribe to my channel. I put out weekly watch list videos along with the general trading videos like this and personal finance content. The first requirement for a follow-through day to occur is that the market is dealing with some sort of correction. Now, you could argue what constitutes the market being in a correction. The most general definition would be when the major indexes, the S&P 500 and NASDAQ, are between 10 and 20% off their highs. Right now, the S&P 500 has only pulled back 5.9%, while the NASDAQ has pulled back 7.4%. So by that definition, the market's not in a correction just yet. But that's not what MarketSmith says. They've deemed the current outlook as market in correction, and I agree with them. I mentioned earlier that there have been high volume sell-off days during this recent market pullback. This is referred to as a distribution day, which occurs when an index is down more than 0.2% on higher volume than the previous trading day. Since the market top on September 2nd, the S&P 500 and NASDAQ have both had 7 distribution days, many of which just occurred last week. This is a sign that big institutional money is leaving the market in fears of a move lower. How market-leading stocks act is also extremely important to the general market health. And recently, leaders have been breaking through areas of support on heavier than normal volume. All of this together, and I would consider the market to be in correction. But go ahead and argue with me in the comments. Next requirement, we need an index to put in a day one. This occurs after the index makes a new low in the pullback, then has a positive close the next day. The day with the positive close marks day one. So now we have the start of a potential rally after being in a correction. But before we get the all-powerful follow-through day, we need to hold the low of day one for the next 3 days. If we don't break under day one's low, then we can start to look for a follow-through day on day 4 or any time after that, as long as the lows of day one holds. And finally, we can get our follow-through day when one of the indexes close 1% or more above the previous day's close on volume greater than the previous day. For example, if the S&P 500 closes up 3% on day 4 or later of a potential rally on larger volume than the previous day, then we have our follow-through day. This signifies the official start of the new uptrend and time to build exposure in the market. All right, great, Nick. So what are we buying? Same thing that I'm always trying to buy. The true market leaders that are breaking out of bases on high volume. You see, during a market correction, you'll be able to identify the true market leaders as the stocks that have pulled back the least on the lowest amount of volume and are holding their key moving averages. Sometimes the market leaders will even be bucking the trend completely, moving higher while the market sells off. These are the stocks that I want to be buying once we get our follow-through day. With one caveat. I'm not going to be putting my entire portfolio back in the market on the follow-through day. Because like everything in trading, there are no absolutes, and a follow-through day can fail. No, I want to be building progressive exposure. Say I put 20 to 25% of my portfolio into the market on the follow-through day. If I'm seeing good progress with the positions, say they're breaking out and continuing higher, then I can roll my stops to even and take on more positions or increase position size without increasing the risk to my portfolio. If this rally is legit, then I'll be able to progressively build exposure while the market trends higher. And if this is the time when one of those follow-through days fail, then I'll only have 20 to 25% of my portfolio at risk. Our job as traders is always to manage risk. So it's important to identify when a follow-through day might be more prone to failure. A follow-through day failure happens when the index breaks below the low of the follow-through day. If that happens, it's time to reduce exposure and wait for a move higher. There are 2 main warning signs that could lead to a follow-through day failure: distribution days in the rally and market leaders not experiencing the same type of rally. Distribution days during the rally before the follow-through day signal that institutions are selling the stocks into the bounce off the lows. And the same concept is true if we get distribution days after the follow-through day. According to TraderLine, if we get a distribution day on the first 2 days after a follow-through day occurs, there's a 95% chance that the follow-through day fails. If a distribution day occurs on the 3rd day, then it's 70% likely that the follow-through day will fail. And if it happens on day 4 or 5, then there's only a 30% chance of failure. I mean, it makes sense. We want to avoid large volume sell-offs during the rally off the lows. We want institutions back in the market, buying stocks and pushing them higher, not exiting on a bounce. The second warning signal is that the market leaders aren't acting right. You'd expect money to be flowing into the stocks that show the best relative strength during the market correction once we get the follow-through day. Monitoring the market leaders is a great way to gauge the market at any time. If the leaders are acting well, chances are your portfolio will be too. But if they're breaking down, maybe it's time to step aside for a bit. Now we'll jump to the charts to look at some historical examples of follow-through days, October of 2018 and April of 2020. The first example we'll look at is the market crash in 2020. This is a great example to use because there are a couple of rallies that don't quite meet the criteria for a follow-through day, and then you can see the market move lower because of that. So the market topped out on the 19th, and we're looking for a correction first. So if you go with the 10% needed for a correction, then you can see we kind of meet that threshold on the 27th of February. So after this point, we can start looking for a day one and then a follow-through day on day 4 or later. Our first day one happens on the 28th because we close above the close of the previous day. So here's day one. Now we need to make sure we don't break below the low of day one, otherwise it's invalid. Days 2 and day 3 don't break under the lows, so that's good. Now we're looking for our follow-through day on day 4 or later. And it looks like we get it here, right? Because we moved up about 4.1% against the previous day's close, so that meets our 1% threshold, but it doesn't meet the volume threshold. You can see here, we closed higher, but on lower volume than the previous day. So this is not a follow-through day. Just because it's not a follow-through day doesn't mean it can't be later on. As long as we don't break below the low of day one, it's still valid. But unfortunately, you can see on the 9th, we break under the low of our day one, so now we need to put in a new day one. We actually get that the next day on the 10th, so that's our new day one, but we break under that day one's low the next day, invalid. We keep kind of doing that until we hit the final market low on March 23rd. So the next day, the 24th, will be our day one because we close higher than the close on the 23rd. Now from here, as long as we don't break below the low of day one, it can be a valid rally. We can see day 2 and day 3 don't break below the low. So now we're looking for our follow-through day, day 4. And it looks like we get it here, but again, volume does not surpass the volume of the previous day, so this is not a follow-through day. Next day, we have inside candle. Again, nice strong move up, but does not qualify for a follow-through day because it came on less volume than the previous day. We finally get our follow-through day on April 2nd, where we closed above the previous day's close by 2%. All we need is 1%. And we do so on heavier volume than the previous day. So that's our follow-through day. And right there on that day would have been the best day to get back into the market after it crashed in March of 2020. Now I know there is a difference between the QQQs and the actual NASDAQ composite. In the NASDAQ composite, this day didn't have more volume than the previous day, so we didn't see the actual follow-through day until April 6th. But for this example, this is checking all of our boxes for a follow-through day, so that's what I'm using. Either way, if you used April 2nd or April 6th as your follow-through day, you could see that was the start of the new uptrend and up until September. So let's kind of measure that. Just a broad range, 62% increase from that follow-through day. That's when you want to start putting exposure back into the market leaders and practicing progressive exposure. For our final example, we'll use October of 2018. This is a good example because it shows 2 different follow-through day failures. You can see here that the market topped on October 1st, and then we got our 10% pullback, getting there on October 11th, putting in the first low. Here we have day 1, day 2, doesn't break under the low of day 1, day 3, day 4, now we're looking for a follow-through day. This closed up, but not above 1%, and did so on lower volume than the previous day, so it's not a follow-through day, but it's not a failure until we break under the low of day 1 on the 23rd. So again, now we're looking for a new day 1. Here's a day 1, we break under the low, invalid. Next day 1 we have is the 30th, day 2, day 3, now we're looking for our follow-through day. Day 4 was down, day 5 was down, but not under the low of day 1, so we're good. Day 6, up, but not over 1%, and not on heavier volume than the previous day. Finally, we do get a follow-through day on the 7th, above 1%, let's see, that was up 3.2%, and on above volume, a volume above the previous day's high, so that is our follow-through day. Unfortunately, we get a sideways action and then a follow-through day failure on the second day when we undercut the low of the follow-through day. And we do so on heavier volume, so this is also considered a distribution day. Now we need to find another day 1 and start counting over again. We get a day 1 here, day 2, break under the low. looking for a new day one. New market low, day one, breaks under the low. Here we go, day one, day two, day three, day four. We're looking for a follow through day four and later. This day was down a little bit. This next day was up, but doesn't meet the volume requirements or above 1%. We do get the follow through day on December 3rd here. We closed up 1.7% on higher volume than the previous day. So this is our second follow through day. And you can see right away, the next day, that gets invalidated because we move under the low of the follow through day's low. And we do so on heavier volume, another distribution day. So maybe third time's the charm, right? Day one, failure. Day one, day two, day three, day four, day five, eventual failure on this. Finally, the market does bottom on the 24th of December. The 26th is our day one, day two, day three. Now we're looking, day four is closes up, but not over 1% and not over our volume threshold. Next day, same story, not over 1%. Then we get a down day, and finally we get our third follow through day. We move up. Let's see, this was 4.2%. So that obviously meets the 1% requirement, and we do so on just barely enough volume to beat the previous day's volume. So this is our follow through day, and you can see from here we get a nice strong uptrend from there of about, 22% from our follow through day's close to the high before we go through another market pullback. We just covered a ton of valuable information. So before you go, let's review what we covered. When the markets are in a downtrend or in a correction, one useful signal to start building exposure in leading stocks is after a follow through day occurs. A follow through day occurs when the S&P 500 or NASDAQ closes 1% or more above the previous day's close on higher volume than the previous day, on a day four or later of an attempted rally off the low. The rally attempt officially starts on day one when the index closes higher than the previous day, which put in a new low. Follow-through days, like everything in trading, don't always work. But here are two things to check that increases the odds of failure. The first is if we see a distribution day in the first 5 trading days after the follow-through day occurs. And the second is if leading stocks aren't breaking out on larger than average volume. And again, we don't want to go all in at once. We want to build progressive exposure in the leading stocks. Thank you so much for tuning into today's video. If you learned anything new, please help me out by absolutely obliterating the like button and subscribe to my channel. I make trading videos like this along with a weekly watch list, a trading live stream on Tuesday night, and other personal finance videos. Have a great day, and I'll see you next time.